Most traders lose, not because they lack knowledge, but because they lack the discipline to wait for the market to reveal its true intentions. Richard Wyckoff taught that the market whispers long before it speaks, but most traders rush in, chasing shadows. Imagine watching a stock drift sideways. After a sharp decline, volume dries up, the selling pressure weakens, and price quietly holds at a support level. The impatient trader jumps early, guessing, but the Wyckoff student waits patiently until the true signal arrives, a clean spring with a surge in demand, followed by a successful test. That is the moment the composite operator reveals his hand. In trading, waiting isn't weakness. It's the highest form of strength. Those who learn to wait for the signal stop gambling and start trading with precision. Ladies and gentlemen, today we're stepping into one of the most misunderstood, yet most profitable skills in all of trading, the art of waiting for the signal. In the world of financial markets, impatience is expensive and guessing is fatal. Richard Wyckoff taught that the market is a carefully orchestrated operation run by professionals who never reveal their intentions too early. They leave footprints, subtle, deliberate, methodical, and only those with the discipline to wait can see the true direction. This journey isn't about predicting the market, it's about understanding it. And once you master the ability to wait for the right confirmation, you stop chasing moves and start aligning yourself with the very forces that move the market. Tonight, we explore how patience transforms your trading from reactive to strategic, from emotional to intelligent, and from chaotic to consistently profitable. Let's begin. In trading, patience is not just a virtue, it is a weapon. And when Richard Wyckoff spoke about studying the market's true intentions, he made one principle unmistakably clear: never act without confirmation. Patience in confirmation means you do not trade based on hope, fear, or the illusion of opportunity. You trade only when the market itself proves that the setup you anticipated is genuinely unfolding. This is the point where impulsive traders and trained traders take completely different paths. Most traders operate on emotional timelines. They want action, they want movement, they want immediate results. But the market does not reward urgency, it rewards accuracy. The disciplined trader understands that every valid setup, accumulation, markup, distribution, markdown, has a moment where probabilities shift decisively. Before that moment, the market is noise. After confirmation, the market becomes opportunity. Wyckoff taught that patience begins with observation. You watch price behavior evolve the way a detective watches a suspect calmly, carefully, without rushing to conclusions. For example, inside an accumulation range, price may dip below support multiple times, trapping impatient buyers and shaking out weak hands. Each dip looks like a potential reversal to the untrained eye. But to the Wyckoff trader, none of these mean anything until confirmation arrives, until there is a spring followed by a test that shows supply has truly been absorbed. That test is the confirmation. Without it, the trader is guessing. Patience in confirmation also protects you from emotional manipulation. The composite operator, the hypothetical mastermind Wyckoff described, uses time to wear traders down. He pushes price slowly, unpredictably, and subtly, forcing the impatient to chase every flicker in the chart. This is where most retail traders lose. They jump on early signs, thinking they've spotted the beginning of a move, only to discover it was nothing more than a shakeout or a trap. Patience allows you to sidestep this manipulation entirely. You wait until the composite operator shows his hand through unmistakable price-volume behavior. Confirmation comes in many forms: a break of structure with volume, a successful test, a shift in supply-demand behavior, or a clear inability of price to continue in the previous direction. But the key here is that confirmation is objective. It is visible on the chart. You aren't imagining it. You aren't projecting it. You're witnessing it. Patience in confirmation also leads to clarity. When you wait, your mind settles. You stop looking for trades and start looking for behavior. This clarity increases your accuracy because it filters out the noise. You're not reacting. You're interpreting. You're not guessing. You're aligning with the market's reality. Ultimately, patience in confirmation transforms your trading psychology. Instead of feeling urgency, you feel control. Instead of forcing trades, you wait for the market to invite you in. This shift, this ability to pause, observe, and verify, creates consistency. It allows you to avoid unnecessary losses and position yourself only in high-probability environments. Wyckoff's message was simple yet profound. The market will always give you a signal. You just must be patient enough to wait for it. Understanding market intentions is the heart of Wyckoff's entire methodology. To Wyckoff, the market wasn't a chaotic environment. It was a deliberate operation driven by professional players who left footprints through price and volume. Learning to read the market's intentions means learning to see beyond the candles, beyond the noise, and beyond the emotional turbulence that misleads most traders. It means recognizing what the composite operator's CO is trying to accomplish at every stage, from accumulation to markup, distribution, and markdown. Most traders look at the market and see randomness. The Wyckoff trader looks at the same chart and sees strategy. Market intentions are revealed not in flashy moves but in subtle cues. A drying volume at support suggests selling pressure is weakening, an intention to stop the decline. A sudden surge of volume without corresponding price progress signals absorption. An intention to absorb supply before a bigger move. A breakout that fails instantly often shows the intention to trap breakout traders, not to start a trend. Every action tells a story, and every story has a purpose. To understand market intentions, you must first detach from your own intentions. The average trader enters the market wanting something, wanting a reversal, wanting continuation, wanting a breakout. But the market owes nothing to desires. When your mind is focused on what you want, you become blind to what the market wants. Wyckoff trained traders flip this script. They operate with an empty mind, free of bias, and allow the market to speak before deciding. Consider an accumulation range. Price moves sideways, appearing indecisive. The impatient trader sees wasted time. The Wyckoff trader sees testing, shaking out, absorbing, actions that reveal the intention to prepare for a move upward. The composite operator buys quietly, keeping price within a range to prevent public attention. His intention isn't to reveal strength yet. His intention is to accumulate without attracting competition. Only at the spring or sign of strength does he finally reveal his plan. In distribution, the opposite intention unfolds. The market appears strong, often making marginal new highs. Retail traders see breakout signals. Wyckoff traders see hidden weakness. The intention here is not expansion, but exit. The composite operator distributes his holdings into public demand. Volume patterns, upthrusts, and lower highs reveal this intention long before the markdown begins. Reading market intentions requires studying behavior over events. A single candle means nothing. A sudden spike means little in isolation. But behavior, repeated patterns, consistent reactions, structured tests, reveals deliberate planning. Markets behave differently when controlled by professional accumulation compared to emotional retail panic. These differences are intentional, and a Wyckoff trader learns to decode them. Understanding intentions also means recognizing when the market does not want to move. Sometimes price drifts, consolidates, or even reverses sharply without warning. These are not accidents, they are intentional pauses or traps. A market that refuses to rally despite good news may be preparing for deeper markdown. A market that refuses to drop despite bad news may be under accumulation. Ultimately, the goal is simple. Stop reacting blindly and start interpreting purpose. When you understand market intentions, trades become clearer, risks become smaller, and your confidence grows. You no longer chase moves, you follow footprints. You no longer guess direction, you read it. And you no longer fear the market, you understand its motives. One of the greatest challenges a trader faces is learning to distinguish signal from noise, the meaningful actions of the market from the meaningless fluctuations. Richard Wyckoff emphasized that the majority of price movement is nothing more than background chatter designed either to confuse the inexperienced or to disguise the true purpose of the composite operator. To trade successfully, you must develop the ability to filter the chaos, extract the truth, and focus only on the movements that carry intent, structure, and consequence. Noise is what most traders obsess over. Every candle, every tick, every small pullback seems like a clue, but this constant movement often reflects nothing more than random activity, algorithmic flickers, liquidity sweeps, and emotional trades from inexperienced participants. Noise demands attention, but it delivers no clarity. It misleads, distracts, and creates false urgency. A trader trapped in noise becomes reactive, emotional, and impatient, jumping into trades that never had the weight of real institutional decision behind them. Signal, on the other hand, is rare. It is structured, purposeful, and deeply rooted in supply and demand. A true signal reflects the footprints of professional money absorption, tests, springs, upthrusts, genuine breakouts, and clean changes of character. These signals align with market logic, not emotion. They show intent, not impulse. And most importantly, they form the foundation of high-probability trading decisions. To understand the difference, imagine a trading range where price ricochets through support and resistance. Impatient traders interpret every bounce as reversal, every dip as breakdown. They see signals everywhere. But a Wyckoff trader sees noise because none of these movements are supported by volume behavior, structural cues, or changes in supply-demand. Only when the market gives a spring followed by a low volume test, where sellers have dried up and demand steps in, does the real signal reveal itself. Everything else was noise designed to shake out the weak and confuse the uninformed. Volume plays an essential role in separating signal from noise. Noise often comes with inconsistent volume or volume that contradicts price movement. For example, wide candles on low volume indicate a lack of institutional interest, noise, but a small candle after a large downward move, with volume collapsing, may signal absorption, a true signal. Similarly, a breakout on low volume is often noise, while a breakout after clear absorption and a surge in demand is a genuine signal. Another way to identify signal is through context. A bullish candle in a bearish trend means very little, it's likely noise. But the same candle after a selling climax and successful secondary test suddenly carries meaning. Wyckoff taught that price behavior only makes sense when observed in relation to what came before. Signals are contextual, noise is isolated. Emotion is also a major contributor to noise. Fear-driven dumps, greed-driven spikes, and news-driven volatility often create erratic movement that appears significant but lacks institutional participation. Wyckoff traders avoid reacting to these moments. They watch, observe, and wait for structured behavior, a test, a break of character, a shift in dominance. At its core, mastering signal versus noise transforms your trading. It gives you calm in chaos. It sharpens your decision-making. It reduces false trades and increases the accuracy of your entries. When you no longer chase noise, you begin to see the market the way the professionals do. A battlefield of deception where only a few movements truly matter. By focusing on signal and ignoring noise, you gain the power to act with precision, confidence, and consistency, exactly as Wyckoff intended. At the core of Wyckoff's entire market philosophy lies one timeless truth. Price moves only when supply and demand shift out of balance. If you can learn to read this imbalance, you stop trading hope and start trading reality. Supply-demand alignment is the key to understanding why a market moves, when it's likely to move, and in which direction. It is the foundation of all meaningful signals, and the reason waiting for confirmation becomes so powerful. Most traders chase indicators, pattern names, and predictions, but Wyckoff traders focus on the only thing that truly matters: who is dominating the market, buyers or sellers. And just as importantly, at what moment does that dominance begin to shift? Because it's in those shifts, in the exact instant when supply weakens or demand strengthens, that the strongest trades are born. Supply-demand alignment begins with studying how price behaves at key levels. When the market approaches support, the question isn't, will it bounce? The question is demand stepping in? You look at volume: is it increasing, showing active buying? Is it decreasing, showing sellers are exhausted? If price touches support but volume falls dramatically, this signals a potential drying up of supply, a condition Wyckoff considered essential before a reversal. Without this alignment, any bounce is random noise. Similarly, at resistance or after long rallies, you don't ask if price will drop, you ask if supply is increasing. Large candles with high volume that fail to push price up indicate heavy supply. This is the hallmark of distribution. It is not downward movement that signals weakness. It is the inability to continue upward despite effort. When demand tries to rally price, but supply overwhelms it, the alignment shifts and the direction becomes clear. Wyckoff's genius was in showing that supply and demand reveal intentions before price does. For example, after a selling climax, price may still move sideways or even dip lower slightly, but if volume collapses and downward pushes shrink, supply is no longer dominant. This is alignment. This is where the Wyckoff trader begins to watch for the true signal, the test. The test confirms that supply has dried up and demand is ready to regain control. During a markup phase, supply-demand alignment shows itself through strong rallies, followed by shallow pullbacks. Demand pushes the market upward with conviction, while supply fails to push it back down with equal force. The alignment is clear, the path of least resistance is upward. Conversely, in markdown, rallies are weak and short-lived. Demand is too small to reverse the trend, and supply consistently overwhelms every attempt to rise. The beauty of supply-demand alignment is that it removes guesswork. You no longer hope for reversals or fear continuation. You read the balance of power objectively. Wyckoff traders treat the chart like a negotiation between buyers and sellers. They observe who is winning, who is weakening, and when momentum is shifting. When you learn to align yourself with this power balance, everything changes. You trade less, but you win more. You become selective, patient, and strategic. You stop fighting the market and start dancing with it. Supply-demand alignment isn't just a concept. It's the guiding compass behind every professional trade. It shows you the truth behind every move, and once you master it, you begin trading not as a follower, but as an informed participant aligned with the market's strongest forces. If there is one trait that separates amateur traders from true market professionals, it is professional timing discipline. Wyckoff taught that even the best analysis becomes meaningless if executed at the wrong moment. The market rewards timing, not speed, not emotion, not prediction. And timing is a skill sharpened through discipline, the discipline to wait for clarity, the discipline to avoid premature entries, and the discipline to strike only when the odds tilt decisively in your favor. Professional timing discipline begins with a mindset shift. Most retail traders act from fear of missing out on a move, fear of losing opportunity, fear of being left behind. This emotional urgency pushes them into trades before the market has completed its story. Wyckoff emphasizes that the composite operator never rushes. He waits for the perfect intersection of structure, volume behavior, and supply-demand shift. Only then does he execute. True timing means doing the same, observing deeply, acting selectively. Consider a classic Wyckoff accumulation. Price enters a range, volume changes subtly, and the market moves in seemingly random fashion. But the professional does not jump in during the shakeouts, nor on the first bounce from support. He knows the market is still testing. The discipline lies in waiting for a test after a spring, because the test is the timing trigger that confirms supply has dried up. Without this discipline, the trader enters during noise. With it, he enters during signal. Professional timing discipline is essentially the art of entering after confirmation, not before it. Many traders think early entries equal better risk-reward, but Wyckoff knew better. Early entries may offer lower stops, but they also carry lower probability and higher uncertainty. Professional timing is about stacking probabilities, entering when the market has shown a clear change of character, when supply-demand alignment is visible, and when the market has revealed its intention. This discipline also applies to exits. Professionals do not exit emotionally, they exit according to structure. When demand weakens or supply increases, shown through volume anomalies, failed pushes, or break of support, they reduce or close positions without hesitation. Timing discipline means responding to evidence rather than emotion. One of the most overlooked aspects of timing discipline is stillness. The professional spends more time observing than trading. Amateurs interpret stillness as inactivity. Professionals see it as preparation. Wyckoff often emphasized that traders should be in harmony with the market. This harmony comes only from watching long enough to understand the rhythm of accumulation, markup, distribution, and markdown. Only by respecting this rhythm can a trader strike at the exact moment when the trend is shifting, never before, never after. Professional timing discipline also means avoiding trades during uncertainty. When price is in the middle of a range, with no clear dominance from supply or demand, the professional takes no action. He knows the market is undecided. Discipline is not just about knowing when to act. It's also about knowing when not to act. This patience preserves capital clarity and confidence. Ultimately, timing discipline transforms you into a strategic operator rather than an emotional participant. You wait for confirmation, act with purpose, avoid rushing, and align with the market's true power. This is the essence of Wyckoff's teachings: trading not when you want to trade, but when the market gives you permission. In the end, trading is not a battle against the market. It's a battle against your own impatience. Wyckoff showed us that every meaningful move begins with intention, and every intention reveals itself through structure, volume, and the subtle dance between supply and demand. When you learn to separate signal from noise, when you commit to reading the market's true intentions, and when you cultivate the discipline to act only at the precise moment of confirmation, your entire trading identity transforms. You stop chasing trades and start capturing opportunities. You stop reacting emotionally and begin operating professionally. Waiting for the signal isn't a delay, it's your greatest edge. And once you master this art, the market no longer feels like chaos. It becomes a readable, predictable operation where your patience becomes your profit and your discipline becomes your power.